You've probably heard the headlines. New tariffs are hitting imported goods, inflation is expected to rise, and mortgage rates, they're all over the place. But what does this really mean for you, especially if you're thinking about buying a home or selling one? On April 9th, the U.S. government announced sweeping new tariffs aimed at boosting domestic industry. But the housing market, already under strain, is reacting fast. According to Redfin's latest report, these tariffs are injecting a fresh dose of uncertainty into mortgage rates, construction costs, and buyer behavior across the country. If you're watching rates jump from 6.5% to 7.2% in a matter of weeks, you're not imagining things. And if you're a builder suddenly paying more for lumber and steel, you're not alone. In this video, we break down Redfin's key findings and what they mean for your next move in the housing market. Do you think tariffs are helping or hurting the U.S. economy? Drop your take in the comments. I'm reading everyone. So what exactly are these new tariffs and why are they shaking up the housing market? As of April 9th, 2025, the U.S. has implemented a fresh round of tariffs targeting imported goods from major trade partners, including China, Canada, and Mexico. These aren't just abstract economic tools. They directly impact construction materials like lumber, steel, aluminum, and even electronics used in smart home systems. Here's the breakdown. Tariffs now range from 10% to 25% on key building inputs. For example, Canadian lumber, already expensive due to supply chain disruptions, just got slapped with a new duty. That means every home being built in America instantly costs more to construct. But it doesn't stop there. According to economic forecasts referenced by Redfin, inflation could jump to 4.5% by summer, and unemployment may rise to 5%. That combo of rising prices and shrinking job security creates a double threat for both buyers and sellers. These aren't distant future impacts, they're hitting now. Builders are pausing projects and buyers are rethinking budgets, and the market is only beginning to feel the ripple effects. One of the first signs that tariffs are messing with the housing market: mortgage rate chaos. Redfin's latest analysis shows a clear connection between tariff announcements and wild swings in the bond market, particularly U.S. Treasury yields. Why does that matter? Because mortgage rates tend to follow the 10-year Treasury. But right now, that relationship is breaking down. Normally, the gap between the 10-year yield and mortgage rates hovers around 1.5%. Today, it's over 3%. That's not just unusual. It's a red flag. It signals investor uncertainty, pricing risk, and economic anxiety. So if you're a home buyer tracking rates daily, you might have seen something like this: 6.7% on Monday, 6.9% by Wednesday, then suddenly 7.1% Friday afternoon. This isn't just frustrating, it's paralyzing. How do you plan a budget or lock in a rate when the rules keep changing? Redfin also notes that lenders are pricing in future inflation risks. That's causing them to keep mortgage rates elevated even when broader economic indicators suggest they should fall. It's a tug of war between market fear and financial fundamentals. Bottom line, volatility makes it harder for buyers to commit and harder for sellers to price their homes confidently. And this uncertainty, it's slowing down transactions across the board. Tariffs aren't just changing mortgage rates. They're hitting the very foundation of the housing market: construction. Redfin's analysis highlights a sharp rise in the cost of materials like lumber, steel, and aluminum, all critical for home building. When a developer budgets a project at $300,000 per unit and material costs jump by 10 to 15% overnight, that project may no longer be profitable. This isn't theory, it's happening in real time. Builders across the country are delaying new projects or scaling back plans. Some are adding escalation clauses to contracts to protect themselves from price spikes. Others are simply walking away from deals altogether. And fewer new homes means one thing: tighter supply. That's especially dangerous in a market where inventory is already at record lows. Redfin warns that this could trigger a chain reaction. Higher construction costs push up new home prices. As new builds become unaffordable, demand shifts to existing homes, driving up resale prices too. The result? an even more competitive and expensive market for buyers, especially first-timers who are already priced out. This ripple effect also hits renters. When developers can't justify building, multifamily housing slows down too. That limits rental inventory, which could push rents even higher in major metro areas. So even if you're not buying today, you'll still feel it. The cost of shelter, whether owned or rented, is on the rise. If new homes keep getting more expensive, would you rather buy an older home or keep renting for now? Let's hear your strategy in the comments. Tariffs don't just hit wallets, they hit mindsets. And Redfin is seeing a clear shift in how buyers and sellers are feeling about the market. Let's start with wealth perception. Nearly 70% of US homeowners own stocks, so when markets react negatively to tariffs, dropping on fears of trade wars and inflation, homeowners feel less wealthy, even if their income hasn't changed. That perception alone is enough to freeze decision making. Buyers start to second guess. Should I wait until things calm down? What if I lose my job next quarter? Even those who are financially ready become emotionally hesitant. And sellers, they're worried too. With fewer buyers actively shopping, homes sit longer on the market. That creates uncertainty and often leads to price drops or canceled listings. Redfin's behavioral data shows a noticeable decline in search activity in the weeks following major economic disruptions, just like what we're seeing now with the tariffs. In some metros, buyer tours dropped by over 20% in the span of 2 weeks. This isn't just about economics, it's about psychology. When people fear the future, they delay big decisions. And nothing's bigger than buying a home. So even if interest rates stabilize or prices soften slightly, that fear lingers. It slows the market down, not because people can't buy, but because they're afraid to. Redfin is raising a red flag that hasn't been waved in over a decade: the risk of stagflation. Stagflation is the worst of both worlds: high inflation paired with low or no economic growth. And with the new tariffs pushing prices up while weighing down business confidence, that dangerous combination is back on the radar. Here's the setup. Tariffs increase the cost of goods, especially imported materials. That feeds inflation, but at the same time, they can also chill consumer spending, reduce corporate profits, and increase layoffs, slowing growth. If the Federal Reserve sees inflation climbing, but the job market weakening, they're caught in a bind. Normally, they'd lower rates to stimulate growth, but with inflation still high, that move could backfire, fueling even more price hikes. This is what Redfin warns could really break the housing market. Imagine this: inflation stays high, so mortgage rates don't fall. But the economy slows down, wages stagnate, and people lose jobs. Suddenly, fewer people qualify for loans, and even fewer feel confident buying a home. Demand collapses, but prices remain high because supply is still tight. That's a stagnant high-cost market, and it's brutal. Redfin's data scientists note that we're not there yet, but we're closer than we've been in over a decade. The next few months will be critical. If tariffs stick and inflation doesn't cool, housing affordability could hit crisis levels. If you want to see the housing market under pressure in real time, look no further than the Bay Area. Already one of the most expensive regions in the US, the Bay Area is now grappling with the added weight of tariffs, especially on imported building materials. According to Redfin, local developers are seeing material costs jump by 15% or more, forcing many to pause or cancel projects midstream. One builder in San Jose reported shelving 3 out of 5 upcoming developments due to cost uncertainty. And when construction halts in a place where inventory is already scarce, prices hold or climb even in the face of falling demand. Redfin also reports a noticeable decline in buyer activity in the region. Tour requests, online searches, and open house attendance are all down, but prices haven't followed. Why? Because supply is so limited, even fewer buyers are still enough to maintain upward price pressure. It's a classic Bay Area squeeze: higher costs to build, fewer homes available, and an affordability crisis that just got worse. This region offers a preview of what could happen nationally if tariffs continue, tightening the screws on builders and buyers alike. The housing market was already stretched thin. Now, with new tariffs in play, it's being pulled even tighter. Redfin's latest data paints a clear picture. Higher construction costs, volatile mortgage rates, and growing buyer hesitation are creating a perfect storm of uncertainty. Whether you're a first-time home buyer, investor, or just trying to sell your current home, these economic shifts affect your bottom line. But knowledge is power. Understand how tariffs are changing the game. Watch mortgage rates closely. Lock in when it makes sense. If you're a buyer, run the numbers and consider smaller markets or new build alternatives. If you're a seller, know that buyer urgency may have cooled, even if prices haven't. The market is shifting fast. So here's the big question. Do you think these tariffs will cause a housing slowdown, or will prices just keep climbing? Comment below with your take. If you found this breakdown helpful, don't forget to like this video, subscribe to the channel, and hit the bell so you never miss the latest on housing market moves that could impact your future.